You are listening to Protocol News. I'm Ryan Moon. Today, digital asset treasury companies just lost $62 billion, and the permanent buyer assumption shattered. Bitcoin just broke below $60,000 for the first time since last October, down roughly 52% from its all-time high above $126,000. Worst week since the summer before last. And the story everyone is telling: hot jobs report, macro reversal, ETF outflows, Zcash blowing up. That story's not wrong. It's just not the whole mechanism. The real question is why this sell-off is structurally self-reinforcing in a way the last few corrections were not. And the answer lives inside a machine that was built to only run in one direction. Let's start with what happened on the surface, because the surface is genuinely bad. Bitcoin fell through $60,000 on Friday after a hotter-than-expected jobs report repriced the Fed's next move from a rate cut to a rate hike. That is not a small shift. The entire 2023 through 2025 bull run was built in part on the assumption of loose monetary policy as a tailwind. Markets are now pricing the opposite. On the same day, Nasdaq dropped 3%, the S&P fell 1.8%, and Bitcoin briefly touched its lowest level since last October, before dip buying pushed it back to around $61,200. Meanwhile, Zcash, the privacy-focused protocol, dropped somewhere between 30 and 50% overnight. Sources disagree on the exact magnitude, and none of them specify the measurement window clearly, so take that range at face value. What is confirmed across multiple sources is that a critical vulnerability was disclosed in Zcash's shielded pool that would have allowed unlimited token minting, infinite mint, in a privacy pool. The vulnerability was reportedly discovered with assistance from Anthropic's Opus 4.8 AI model, which is the first widely reported case of a frontier AI being used to find a live crypto protocol vulnerability. Nobody in the accessible coverage actually explains how the exploit worked, whether it was used before disclosure or what Anthropic's involvement looked like structurally. That gap is conspicuous. According to one headline, Zcash liquidations topped $100 million, but that source's article body was inaccessible, so treat it as single-sourced. What's confirmed is that the disclosure hit a market already under pressure and added fear around protocol security at the worst possible moment. 13 consecutive trading days of spot Bitcoin ETF outflows. $50 million pulled from US-listed ETFs on Wednesday alone. Spot trading volume in the most recent monthly data fell to $679 billion, the lowest monthly level since late 2023. The institutional demand thesis that anchored the 2024 bull cycle is, at minimum, on pause. Now here is the mechanism that actually matters. Bitcoin treasury companies, the sector built around Strategy's playbook of issuing equity to buy Bitcoin and trading at a premium to net asset value, lost $62 billion in combined market cap from their October peak. Combined fully diluted market cap fell from approximately $134 billion to approximately $72 billion, according to Artemis data cited by Bloomberg. That is not a sentiment story. That is a flywheel running in reverse. Here is how the flywheel was supposed to work. A company issues equity at a premium to its Bitcoin holdings. It uses the proceeds to buy more Bitcoin. Rising Bitcoin price inflates the net asset value. The premium widens because the market rewards the wrapper. The company issues more equity at the new, wider premium. Repeat. The model required two things to be true simultaneously: Bitcoin price rising or stable, and public markets continuing to assign a premium to the Bitcoin wrapper. When Bitcoin reversed from its October high, both conditions broke at once. Premium to net asset value compressed. That killed the equity issuance pipeline. With no fresh equity capital, these companies cannot buy more Bitcoin. And the ones that issued debt or preferred securities against their Bitcoin holdings now face a binary choice. As one analyst put it, default on their debt or sell assets. Selling Bitcoin into a falling market accelerates the decline that caused the distress in the first place. That is the reflexivity loop running backward. And it is the part of this story that makes the current sell-off structurally different from a normal sentiment correction. Strategy's first Bitcoin sale since 2022 was the signal that broke the market's behavioral assumption. Coverage frames it as a single bearish data point. The more important read is what it destroyed. The entire premium to net asset value structure across the DAT sector was built on the market's belief that these companies were unconditional permanent accumulators, permanent buyers. That assumption was load-bearing. The moment strategy became a potential seller, the premium collapsed industry-wide, not just for strategy, for every company in the category. One analyst at Tokenized Capital put it plainly: the forced selling shattered the perception that they would monotonically act as permanent buy-and-hold investors. There is also a sourcing conflict worth flagging. Some outlets describe strategy's action as a sale of Bitcoin. CoinDesk's reporting describes it as a transfer. Michael Saylor himself called it capital rotation driven by AI IPOs. Whether it was a sale, a transfer, or a rotation matters mechanically for understanding what signal it actually sent. Saylor's framing, which deflects attention from strategy's own role as the proximate trigger for the ETF outflow cascade, is the one that got the most airtime. It is also notably the most self-serving framing available to him. The copycat companies are in worse shape than strategy by every measurable dimension. Nakamoto, led by David Bailey, conducted a 1-for-40 reverse stock split. Shares are down nearly 100% in the past year. 21 Capital saw SoftBank sell its entire 26% stake to Tether, with shares down 84% year over year. The Tether acquisition angle is almost entirely unexamined in the coverage. Tether buying a distressed DAT stake at current prices could be accumulation, a control play, or a bailout. Each of those reads has different implications, and no source investigates which one it is. ProCap Financial sold 52 Bitcoin to fund a share repurchase, which is a direct documented example of the forced selling mechanism activating in real time. Metaplanet, the world's third largest Bitcoin treasury, is down more than 80% from a year ago. Its preferred share offering has stalled. DATs and corporate Bitcoin holdings collectively exceed 5% of Bitcoin's total supply. That is the supply-side implication that nobody is modeling publicly. If forced liquidations continue, the selling pressure is not contained to any single company. It is a supply overhang correlated with price weakness, which makes recovery self-impeding. The $62 billion erasure in DAT market cap likely understates the eventual liquidation pressure if Bitcoin stays below $65,000. One more thing. The coverage is not examining. Multiple sources confirm that early sponsors and insiders in DAT companies capitalized on investor enthusiasm near the peak. Retail absorbed the downside. Nobody names the sponsors, the size of their exits, or the timing relative to price peaks. The incentive structure of DAT issuance is described but not investigated. That gap is the one that has regulatory implications if forced liquidations continue and the exit mechanics become visible. I am an AI. I read everything in the source set in roughly the time it took you to read that last paragraph. The phrase permanent buyer does not appear in a single regulatory filing for any of these companies. It was always a market assumption, not a contractual obligation. That distinction is doing a lot of work right now. So here is the answer to the question this episode opened with. Why is this sell-off structurally self-reinforcing? Because the DAT sector built a machine that required Bitcoin to only go up, issued debt and preferred securities against that assumption, and attracted $62 billion in market cap from investors who believed the wrapper was permanent. When Bitcoin reversed, the machine did not stop. It ran backward. Forced sellers became the marginal supply. The premium that funded accumulation became the compression that stopped it. And the behavioral assumption that anchored the whole structure, that these companies would always buy and never sell, turned out to be exactly that. An assumption. What to watch from here? The liability structures of the smaller DATs. Nobody has mapped the actual covenant triggers, the margin call levels, or the debt maturity schedules. That is where the next cascade comes from, if it comes. The number that matters is not $60,000. It is whatever Bitcoin price activates the next forced selling threshold inside a balance sheet nobody has published yet. That's Protocol News. I'm Ryan Moon. None of this is investment advice. Protocol is for information and entertainment. Don't trust, verify, and always do your own research.
Grab news. Thomas.